Recording start होता बता दूं। Hello everyone, myself Dhiyesh Shah and we as Group 1 are going to present Value Investing and Behavioral Finance inspired by ideas of Parag Parikh sir and his book Value Investing and Behavioral Finance. The central thought behind this topic is very powerful. It is mastering markets by mastering the minds. Because at the end of the day, markets are not just driven by numbers, data, or logic. They are driven by human behaviors and emotions. Next slide, please. Let's begin with the author. Parag Parikh sir was one of the pioneers of value investing in India and the founder of PPFAS Asset Management. What made him stand out was his strong belief in long run and disciplined investing. He didn't just focus on financial analysis, but also on something most investors ignore how psychology affects decision making. According to him, understanding the market is important, but understanding your own behavior as an investor is even more important. Next slide. Now, moving to the concept, investing is beyond luck and skill. A lot of people think successful investing is about lucky or highly intelligent, but in reality, it's neither. First, it's not about luck. Consistent success comes from discipline and a structured approach. Second is behavior, which plays a major role. Many investors believe they are rational, but their decisions are often driven by emotions like fear or excitement. Third, and there is a problem of short term temptations. People tend to chase quick profits and reacting to market trends, but this usually leads to poor long term outcomes and eventually the human nature. Emotions like greed, fear, or even overconfidence leads to repeated mistakes. So what really matters in long run? Patience, discipline, and self-control. Now, next slide, please. This brings us to how investors' psychology works in real markets. Markets move in cycles, and these cycles are driven by emotions. When prices starts rising, greed kicks in. More and more investors start investing, pushing prices even higher. This leads to overvaluations, where assets are priced much higher than their true value. After a point, reality hits. Fear takes over, and investors start panic, and they start selling, which leads to sharp declining and corrections in the market. Eventually, market reaches a stage where undervaluations are existing, good opportunity are existing, but most people are too afraid to invest. Another common behavior is herd mentality. People simply follow what the crowd is doing instead of thinking independently. But successful investors do exactly opposite. They stay calm, rational, and focus on long-term fundamentals, even when markets are reacting emotions. So investing is not just about knowledge, intelligence, or timing the market. It is about controlling your emotions, staying disciplined, and thinking long term. As in the end, the biggest challenge in investing is not the market itself, it is your own mind. Now, I would like to hand over the platform to Ashlesha to take the discussion forward.
Thank you, Jay. Now let's understand behavior trends. Behavior finance focus on psychological influence on decision making because market is not always efficient, especially in the short run. Now let's understand which obstacles are there for pursuing value investing. First is error of judgment. People assume that whatever the business has done in a recent past year will be continue in the future. It can be possible, but it is not necessary because investors assume that value return is equal to growth return and make decision according to it. Next is well-run companies is equal to good investment. So if a good company make poor decision and due to which fund manager has to lost his job, at that time we can say that it's not about picking a good company. It's about not to overprice it. Next is instant gratification. Instant gratification means investors want quick return, but value stock require patience. And even if it look boring method or very unpopular method, whatever truly matter is whether the business will give profit in the long run or not. Next is loss aversion. Due to the pain of loss is felt more intensely than a pleasure on an equal gain, it will tend to lose big share of investor because they don't want to hold that share for long time. Due to loss aversion effect, uh, this happened. Uh, this happened due to the short-term fluctuation of share price. Next is valuation heuristics. So, uh, investor use many methods for the problem when problems are very complex or information is incomplete. They are price to earning, price to sales, or price to book value, etc. Next slide, please. Now let's understand behavior trait for pursuing growth strategy. First is availability heuristics. So growth stock are so much in popular that everyone discuss about it and every broker do recommended it. So we can say that information regarding growth stock can be available easily. So every investor do chase it. Second is follow the herd. Investor has the mentality to buy whatever others are buying and sell whatever others are selling, due to which the stock price to fluctuate rapidly. When everyone is buying, stock price to increase rapidly and it decline when everyone is selling it. Next is instant gratification. So investor want quick return and growth stock has the ability to satisfy this need of investor. Due to which investor prefer growth stock more as compared to value stock when they want instant gratification. Next is realization trap. So after following herd and making decision, people tend to prove that that decision was right, even if it was wrong, and they blame others for their own decision when the stock price falls down. Now, I would like Prasanth to take the lead from here.
Thank you, Ashlisha. Now, my first slide is understanding of contrary investing. Contrary investing is just a simple strategy followed by contrary investors. Like they just not follow the crowd; they just go against it. As many normal investors seeing that if there is a panic-like situation, if there is a fear-like situation, if everyone is selling, so they just sell as everyone is doing. So, but contra investors seeing the fundamentals, seeing the analysis, seeing all the overall potential of a company, the overall potential of assets. After all the readings, they do this step. So markets are driven by fear and greed. If there is a greed like situation, stock price go up, and if there is fear like situation, stock price will go down. This lead to mispricing. So there are five objectives of this contra investing. First, identify undervalued opportunities. So undervalued opportunities means if the net worth, if the company's real worth is less than is their intrinsic value, so that create undervalued assets. So the contra investors are in searching of that undervalued opportunities to go straight into it and just invest in the money into that company. So second point is exploit market overreaction. Many investors overreact to the positive and negative news. If even small announcements create price fluctuations, which cause many emotional responses. So the contra investors not just exploit that news and just follow their own fundamentals. Third, achieve superior long-term returns. As compared to normal investors, they just want average returns as a quick returns. But contra investors is consistent with their undervalued investments and just not follow the crowd. So the fourth point is reduce dependence on market trends. So the popular trends, the popular fancies, the hot sectors are are prevailing in the markets. So that creates problem. But contra investors not just follow that, they just follow their own analysis. Last, enhance margin of safety. So there is a gap. So there is a gap between a real worth and the intrinsic value. So if any contra investors purchasing any asset at a discount rate, so this creates a good because if if there is any uncertain event, so that gap will prevail as a safety to the contra investors. Next slide, please. Now comes strategic approach. So even if the contra investor is smart, so if they go against the crowd every time, so that not could be the reason because every time not possible that going against the ground will be good. So seeing all the strategic will be valuable to the contra investors. First, buying undervalued stocks. That stocks which is currently trading at a low rate. So contra investors searching that stocks which have been ignored, which has been not liked by every market investors. But they believe that that stock which is undervalued will give you good returns. Second, investing during market panics. So everyone knows, and in 2008, there is a massive panic creation in stock prices. So the everyone is have a panic, like everyone is selling, so there is a loss in the stock crash. But contra investors seeing all the companies that everyone is selling, so they do the buying position. Third, avoiding market bubbles. Market bubbles creates when everyone has the same thinking. That if I give example of silver, that recently silver has a market bubble that everyone think that silver will go to 7 to 8 lakhs. So if everyone is buying that silver, that create bubble. So contra investors just avoid that bubble. Long term perspective. So contra investors thinking is long term, not the short term quick profits. So the overall conclusion that contra investing is of discipline, not just following the crowd. So furthermore learnings, I will hand over to Bhavin Thakur.
Thank you, Prasanth. Today, we are exploring a fundamental challenge in investing, the intersection of human psychology and market cycles. First, the behavioral traps in the commodity investing. We start with the psychological barriers that make commodity investing so treacherous. Investor psychology is often the primary risk impacting portfolio performance. The first is representativeness. This occurs when we see a short-term price spike or a small cluster of data points and assume they perfectly represent a new long-term structural trend. We mistake a temporary fluctuation for a permanent change. Next is the round trip policy. This is the painful experience of holding a commodity through its entire boom and bust cycle. Investors get caught up in the excitement, ride the stock to the moon, and then ride it all the way back down, resulting in massive volatility but zero net return for their efforts. Finally, we have herd mentality. This instinct to blindly follow the crowd into overcrowded trades. Ironically, this behavior typically peaks at the absolute top of the pricing cycle, just before the bubble bursts. These biases drive irrational capital allocation and prevent investors from seeing the cycle for what it truly is. Next slide, please. Second, the commodity cycle and the paradox of returns. These behavioral traps feed directly into physical relative commodity cycle. This is an inescapable loop driven by production cost dynamics. It begins with a price boom where supply deficit drives price upwards, generating a massive profit margins or anyone already in the game. This leads to the paradox of returns. High prices, ironically, incentive inefficient. High cost producers to enter the market and aggressively expand supply. As these high-cost players flood the market, we hit oversupply and crash. Supply outstrip demands and prices collapse. We then enter the low-cost survival phase. As prices plummet below the marginal cost of production, the high-cost players go bankrupt, and the only efficient is a low-cost producers remain. These periods of bankruptcies and slash capital expenditure lead to a supply deficit. This massive underinvestment set the stage for the next shortage and the cycles begins all over and again. Next slide, please. The growth trap. This brings us to a final diagnosis, the growth trap. This is defined as prioritizing rapid expansion over fundamental valuation and safety. We fall into this trap through several specific biases. The available heuristics allows the media-driven hype to distort our perception of risks. Overconfidence gives us the illusion that we possess superior market timing or earning prediction skills. We are further blinded by the halo effect, where it focuses on the positive attributes like surging sales while ignoring the deep structural flaws in the business. Because of these biases, investors distортedly neglect the margin of safety, ignoring the core valuation metrics in the pursuit of high growth returns. This leads to the most important takeaway of our presentation, the key lesson. A brilliant business is a poor investment if the entry price is too high. You can be right about a company's growth, but still lose money if you overpaid for the growth. Now I will handle Raghav Kora to begin our.
Thank you, Bhavin. So this slide is all about PSU stocks. Many investors avoid PSU stocks because they believe these companies are inefficient, slow, and not good for investment. Because of this perception, people simply ignore them. But if you look closely, many PSUs are actually strong business They have been operating for years, they survive different economic conditions, and they continue to perform steadily. So the real problem is not in the business, it is the perception. Investors tend to follow what others are thinking. If everyone believes something is bad, they don't even analyze it by themselves. This creates a gap where prices remain low even when the company is performing really well. And this gap creates an opportunity for smart investors who only focuses on fundamentals instead of perception. Over time, when sentiment changes, prices also moves up. So the key idea is that sometimes the best opportunity are hidden where most people are not even looking. Next slide, please. So now let's understand this graph. It shows two things, PSU performance and market perception. Ideally, both should move together, but they are moving differently. PSU performance has been improving over time with better returns and steady growth. However, market perception has remained low. Investors continue to believe that PSUs are not good, even when the numbers are improving. This happens because people stick to the old beliefs and follow the crowd instead of updating their views on based on new data. Because of this, price remain low when the performance is improving. But prices are still low. So it creates an opportunity for investors who understood this and stayed for the long term. They generated huge returns. So in short term, markets are driven by emotion, but in long run, markets are driven by reality. This is something which also happened with PSU, public sector units. Now I'll hand it over to Prakshi. Thank you.
Thank you. Good afternoon, everyone. I'm Prakshi, and I'll be explaining the investor psychology behind the creation of sector bubbles. So many investors follow top-down investing, where they first look at the economy, then identify promising sectors, and finally select the companies. But while analyzing sectors, investors are often influenced by behavioral biases. So the first one is the representativeness bias, where you assume the past winners will continue performing well. The second one is availability bias, where recent sector success attracts more investors. And lastly, the winner's curse, where excessive optimism leads investors to overpay. So these biases drive investors towards popular sectors. But how does a bubble actually form? So as the demand increases, new companies enter the sector, pushing the prices higher. This leads to unrealistic growth expectations, eventually creating a growth trap. This cycle of investor psychology can be clearly seen in the historical sector performance. So moving on to the next slide. Looking at this chart, we can see how sector leadership changes over time. The capital goods sector shows a sharp rise from 2003 to 2007, which was driven by strong economic growth and infrastructure investment. The banking sector also performed well due to financial sector liberalization and improving bank performance. The metal sector also witnessed growth supported by favorable commodity cycles. However, after this period, all the sectors saw sharp correction, showing that the earlier growth was not sustainable for a long period of time. The Sensex appears more stable, indicating that sector-specific investments are more volatile. This chart highlights that chasing hot sectors can be risky, as leadership keeps changing. This leads us to some key investment lessons. Avoid chasing hot sectors and don't always assume that growth guarantees, and be cautious during sector booms. These lessons naturally lead us to IPO investing, where investor optimism is often at its peak. Can we please move to the next slide? So when a sector performs well, companies try to take advantage of investor optimism by launching IPOs. Investors are attracted to these IPOs as they expect new opportunities and quick listing gains. This creates an IPO frenzy, further fueling the investor optimism. However, many IPOs are launched at high valuations, allowing the early investors and promoters to take an exit. While some IPOs do deliver short-term gains, many underperform in the long run. So investors should avoid chasing IPOs in the hot sector and focus on long-term fundamentals. IPO hype is often a continuation of sector bubbles, and understanding this helps investors make better decisions. Thank you, and I'll hand it over to Hardik from here.
Thank you, Prakshidi. Now we will be talking about index investing. Most people think it's a perfectly safe way to grow money without thinking about it. However, there is a paradox. The very strategy meant to be a safe actually has some hidden risk we need to understand. The first problem is the market cap flaw. Many indexes pick stocks just because they are large or have a lot of recent hype. This means that as an investor, you might be accidentally buying stocks that are overpriced exactly when everyone's expectations are at the highest. The next one is the herd trap. Passive investing is basically followed by the crowd. It feels safe because everyone else is doing it. But this safety is often an illusion. It hides the danger of just following recent news instead of looking at the real value of the company. Then comes something called the Lagarde advantage. Data shows that boring stocks that get kicked out of an index uh, might outperform uh, the stocks that get kicked out of an index often might up doing better than the flashy hyped up new stocks. Now last, this brings us to the strategy called the de-indexing. Instead of following the crowd, you look for the solid healthy stocks that the index has thrown away. But by going against the grain, you can often find much better returns over the long term. Now moving to the next slide. Let's look at the bubble trap. This happens when people get so excited that market prices disconnect from reality. The prices keep going up, but they are no longer matched with the companies what they are actually worth. We also get caught in this behavioral traps where we see others profiting like and we feel like we have to jump into it, but we know even it's risky. So, how do you know if you are in a bubble? Look for the red flags. Things like extreme price to earning ratios, constant media hype, etc. The most important lesson from this is to reject the idea that this time it's different. People say that in the every bubble. In the end, fundamental valuations always matter. Don't let the hype distract you from the actual value of what you are buying. Now, I would like Ritika to continue.
Thank you, Hardik. So this slide highlights a major shift in finance thinking from analyzing a company to understanding the investors themselves. Traditionally, finance assumed that investors are rational, but in reality, behavioral finance shows that decisions are driven by emotions like greed and fear. This leads to our first point, the flaw. Traditional models assume logical decision making, but investors often do act irrational. Next is the reality. The decisions are emotional and not purely analytical. Outcomes become unpredictable because human behavior is too much inconsistent. Then comes the mercenaries concept. Investors today are not loyal owners. They are short term players entering and exiting based on news, fear, or hype. So, the shift companies must start studying investor behavior just like they study the customers. And this is the whole core idea of the investor behavior based finance. Finally, comes the goal. By understanding investor psychology, company can do better management expectations, build trust, and reduce the unnecessary stock volatility. So overall, this slide explains that stocks price are not just driven by business performance, but also by how each investors behave to them. Can we move to the next slide? So this slide basically explains how companies can classify the investors into different behavioral types to predict the market reaction. Firstly are the organization mavens. These investors focus highly on strong leadership and corporate governance, and their decisions depend heavily on the management quality. Second are the strategy junkies. They think of long-term plans and they are mostly interested in business models, expansion plan, or strategic growth. Third are the financial addicts. These are short-term traders and they react to quarterly results, dividend, or any immediate final performance. And lastly comes the passive institutions like pension funds. They invest in the long term and provide stability to the market. Now, why is it important for us to study this? Because it emphasizes that it helps the investors, it helps the companies to map their investors so that they can predict the price movements, better communication, and reduce the volatility. So the key takeaway here is that market move not just because of the numbers, but because of different types of investors reacting differently to different situation. Can we move to the last slide? Yeah. So this final slide summarizes the core lessons that we have learned throughout the entire book. Firstly is the behavioral awareness. Investors must recognize their own biases like overconfidence, herd mentality, fear, greed, or any other emotions. Second is the self-discipline. Success in investing depends on controlling the emotions and avoiding impulsive decisions. This book clearly states that inability to do so will lead to failure. Third is the price value equation. Return depends on the price you pay and not just the quality of the business. Fourth is the contrarian courage. The best opportunities comes when you go against the crowd, especially during the fear-driven market. And finally comes the strategic patience. Wealth creation take time. You cannot expect instant result by investing. So overall, the conclusion is that successful investing is not let alone about intelligence, but also about controlling your emotions, patience, and discipline in decision making. I hope that our presentation has added value to your learning, and thank you for your patience.